How much debt do you have?
12,000.
15,000.
$16,835.
18, maybe?
Imagine an economy where millions of people are constantly buying things they can't fully afford. Phones, cars, furniture, vacations, even everyday purchases, paid for with money that hasn't been earned yet. At first glance, it looks like convenience. Credit cards, monthly payments, buy now, pay later options. Everything designed to make life easier.
I had a repo, and then I went and got a new car.
But behind this system lies something much bigger. Because in the modern economy, debt isn't just common, it's essential. In fact, many of the world's largest companies quietly benefit when consumers stay in debt. Not because they want people to struggle financially, but because the entire economic machine works better when people spend more than they currently have.
Data shows that many Americans are missing the mark on executing financial basics like budgeting, building emergency savings, paying bills on time.
The more people borrow, the more they buy. And the more they buy, the more profits corporations generate. Over time, a powerful system has developed, one that encourages spending today and paying later.
The consumer use of buy now, pay later continues to grow.
Many consumers in all segments are using it. It's become pretty ubiquitous on online shopping, at checkout, and also is offered in many stores.
But when borrowing becomes the foundation of consumption, it raises an uncomfortable question. Is consumer debt simply a financial tool, or has it become a core strategy of modern business? To understand why large corporations benefit from debt, we first need to understand how the modern debt economy was built. The rise of the debt economy. For much of the early 20th century, consumer debt was relatively rare. People were far more cautious about borrowing money. Large purchases often required years of saving. But after the Second World War, the global economy began to change rapidly. Industrial production surged, new products flooded the market, and companies needed customers who could buy more goods more frequently. That's when consumer credit started to expand. Banks and financial institutions began offering loans for cars, appliances, and homes. Soon after, credit cards entered the picture, first as simple charge cards, and eventually as revolving credit systems that allowed people to carry balances from month to month. This shift changed consumer behavior in a fundamental way. Instead of waiting until they had enough money to buy something, people could purchase it immediately and pay over time. For businesses, this created a massive opportunity. When customers no longer needed full cash up front, the size of the potential market expanded dramatically. More people could afford cars, more people could buy electronics, more people could upgrade their lifestyles sooner. Credit effectively increased purchasing power without increasing actual income. And for companies selling products, that meant one thing: higher sales. Over time, borrowing slowly became normalized. Credit cards became a routine part of everyday life. Loans became easier to access. Financing options appeared everywhere, from department stores to car dealerships. What once seemed like a financial risk gradually became a normal feature of consumer life. But the real reason corporations embrace this system goes deeper than convenience. Because when people spend using borrowed money, something interesting happens. They tend to spend more. Why debt increases corporate profits? From a corporate perspective, credit doesn't just help customers, it transforms how they behave. Numerous studies have shown that people spend significantly more when using credit cards compared to cash. When paying with cash, every purchase feels immediate and tangible. You see the money leaving your wallet. But with credit, that sense of loss becomes delayed. The payment happens later, often weeks or even months after the purchase itself. This psychological distance changes spending behavior in powerful ways. Customers feel more comfortable making larger purchases. They are less sensitive to price differences, and they are more likely to add extra items during checkout. For businesses, this means higher average transaction values. A customer who might hesitate to spend $800 in cash might feel perfectly comfortable financing that same purchase over monthly payments. Instead of thinking about the total price, consumers start thinking about affordability in terms of smaller installments. Suddenly, an expensive item doesn't feel like an $800 purchase. It feels like a $35 monthly payment. And when millions of consumers start making purchasing decisions based on monthly payments instead of total costs, the scale of the market expands dramatically. For large corporations, this shift has enormous implications, because when credit expands spending power, corporate revenues grow with it. And that's exactly why many companies have built entire financial ecosystems around consumer borrowing. The credit card industry model. To understand why debt is so profitable, we need to look closely at one of the most powerful financial tools in modern consumer culture: the credit card. At first glance, credit cards appear simple. They allow people to make purchases today and pay for them later. But behind this convenience lies a sophisticated financial system designed to generate revenue in multiple ways. Every time a credit card is used, several streams of income are created. First, there are interest payments. When cardholders carry a balance beyond the payment period, interest begins accumulating, often at rates significantly higher than traditional loans. Second, there are late payment fees. Missing a payment by even a few days can trigger penalties that quickly add up. Third, there are transaction fees paid by merchants. Every time a customer uses a credit card, the retailer pays a small percentage of the transaction to the payment network and issuing bank. And finally, some cards generate revenue through annual membership fees and premium services. When combined, these revenue streams make the credit card industry one of the most profitable sectors in global finance. But here's the key detail. The system works best when consumers don't pay their balance in full every month. If everyone paid off their credit cards immediately, interest income would disappear. The industry would still make money from transaction fees, but its largest profit engine would shrink dramatically. Instead, the most profitable customers are those who carry balances over time, slowly paying off purchases while interest accumulates in the background. In other words, the system quietly depends on revolving debt. This doesn't mean companies actively want individuals to struggle financially, but structurally, the model benefits when debt remains part of everyday financial life, and credit cards are only one part of a much larger ecosystem. The explosion of buy now, pay later. In recent years, a new wave of financial technology has taken the concept of consumer debt even further. Buy now, pay later services, often called BNPL, have rapidly spread across online shopping platforms and retail stores. These services allow customers to split purchases into several smaller payments, often with little or no interest if payments are made on time. At first glance, this model seems harmless, even helpful. Instead of paying a large amount upfront, consumers can divide the cost into manageable installments. But from a business perspective, the benefits are enormous. Retailers using buy now, pay later systems often see higher sales conversion rates. Customers who might hesitate at the full price are more likely to complete purchases when the cost is broken into smaller pieces. For example, a $600 purchase might suddenly feel far more manageable when presented as 4 payments of $150. Psychologically, the barrier to buying becomes much lower. And when that barrier drops, consumers often buy more frequently and spend more overall. Companies also benefit because buy now, pay later systems reduce the immediate financial friction of purchasing decisions. Instead of delaying purchases, consumers can act instantly. Over time, this leads to an increase in consumption across entire markets. But there is a subtle risk hidden in this model. While each individual installment might appear small, multiple purchases across different platforms can quietly accumulate into a complex web of financial obligations. Because payments are spread out, consumers may underestimate how much debt they are actually carrying. What began as convenience can gradually turn into financial pressure. Yet from a corporate perspective, the system is highly effective. Because the easier it becomes to borrow, the easier it becomes to sell. And this brings us to an even deeper part of the strategy, one that has less to do with finance and more to do with human psychology. Debt as a consumer behavior strategy. Large corporations understand something fundamental about human behavior. People prefer immediate rewards over delayed consequences. When faced with the choice between enjoying something today or waiting months to afford it, many people naturally choose the immediate option. Debt makes that possible. Instead of postponing gratification, consumers can access products and experiences instantly. From smartphones to cars to luxury goods, financing options allow people to upgrade their lifestyles without waiting. Over time, this changes how consumers evaluate purchases. Rather than thinking about total price, people begin thinking in terms of monthly affordability. A $2,000 product no longer feels like a $2,000 decision. It becomes a $70 monthly decision. And once consumers begin thinking this way, purchasing power expands far beyond what income alone would allow. For corporations, this transformation is incredibly powerful, because when millions of people shift from "can I afford this" to "can I afford the monthly payment," the scale of the market grows dramatically. And the more spending expands, the more the economic machine continues to turn. But there's an important question beneath this system. What happens when an economy becomes too dependent on borrowing? That's where the deeper risks of the debt-driven system begin to appear. The economic system that encourages debt. At this point, it becomes clear that consumer debt is not just a financial habit. It is deeply connected to the structure of the modern economy. Multiple powerful industries benefit from a system where borrowing is common and spending remains high. Banks earn interest on loans. Credit card companies collect fees and revolving interest. Retail corporations sell more products when customers can finance purchases. Financial technology companies profit by making borrowing faster and easier. Together, these sectors form a vast financial ecosystem built around consumer credit. But the influence of debt goes even further. In many countries, consumer spending represents one of the largest components of economic growth. When people buy goods and services, businesses expand, jobs are created, and the economy grows. This means governments and policymakers often have a strong incentive to maintain consumer activity. And credit plays a major role in keeping that activity moving. If consumers suddenly stopped borrowing and began spending only the money they currently earn, overall consumption would likely fall sharply. Retail sales would slow. Corporate profits would decline. Economic growth could weaken. For this reason, modern economies often encourage access to credit as a way to stabilize spending. Low interest rates, easy financing options, and widespread credit availability can help keep the economic engine running. But systems that depend heavily on borrowing also carry hidden vulnerabilities. Because when spending relies on debt, the system becomes sensitive to financial pressure. The hidden risks of a debt-driven system. When household debt rises too quickly, it can create fragile economic conditions. At first, borrowing fuels growth. Consumers buy homes, cars, electronics, and services they might otherwise delay. Businesses expand to meet demand, markets rise, but over time, debt obligations accumulate. Monthly payments begin to consume a larger portion of household income. Interest costs increase, and financial flexibility slowly shrinks. If incomes fail to keep pace with rising debt levels, the system begins to strain. A small economic shock, such as rising interest rates, job losses, or declining asset prices, can suddenly make it harder for many borrowers to keep up with payments. When this happens on a large scale, the effects can spread rapidly through the financial system. Consumers reduce spending to manage debt. Businesses see declining sales. Companies slow hiring or reduce investment. In extreme cases, widespread defaults can trigger financial instability. History has shown this pattern more than once. Periods of rapid credit expansion are often followed by moments when the system reaches its limits. And when those limits are reached, the consequences can ripple across entire economies. This doesn't mean debt is inherently harmful. Credit has played an important role in economic development and opportunity. But when borrowing becomes the primary driver of consumption, the balance between growth and risk becomes much more delicate. Collapse signal. When debt reaches its limits. The modern economy has become deeply intertwined with consumer borrowing. From credit cards to installment plans, from mortgages to buy now pay later systems, debt has become one of the engines powering everyday economic activity. For businesses, this system expands markets and drives revenue. For consumers, it offers convenience and access to products and opportunities that might otherwise take years to afford. But every financial system has limits. Households can only carry so much debt before payments begin to outweigh income growth. And when borrowing slows, or when consumers reach their financial ceiling, the entire system can feel the effects. Sales weaken, credit conditions tighten, economic momentum begins to fade. This is the paradox of a debt-driven economy. The same mechanism that fuels growth can also amplify instability. Because when consumption depends heavily on borrowing, the strength of the economy becomes tied to the willingness and ability of people to keep taking on more debt. And the real question isn't simply why companies benefit from debt. The real question is what happens when the system can no longer create more of it. Sometimes the most important signals in an economy aren't the numbers rising on the surface. Sometimes the real signals appear quietly, deep within the structure of the system itself. And those signals are often the ones that matter most.